You're watching The Language of Business with Greg Stoller.
Christopher Mirabile is the co-managing director of Launchpad Venture Group, a large investor network focused on seed and early stage companies, primarily focusing on high tech. In terms of activity, they are the largest investor network throughout New England and the third largest in the United States. Christopher, welcome to The Language of Business.
Thanks for having me.
So, from your financier's perch, when it comes to risk assessment, and when you hear that term, what is the first thing that runs through your mind?
I guess the first question we always ask is what kind of risk are we talking about? Is it technology risk or market adoption risk or future financing risk or risk with the team? Risk is in everything we do because we go so early. So understanding the type of risk we're talking about is usually the very first question.
So let's assume it's technology risk. How do you factor that in?
We hope the technology's good. You do your best to understand the problem being solved, the current state of the market, the resources that are going to be required, and make the most informed decision you can about the achievability of the technology. And to the extent it's absolutely can't be determined, usually that's reflected in the deal terms.
So let's talk about the deal terms. What does that mean? Are you going to go for a lower valuation of the company? Are you going to go for a higher ownership percentage in the seed or the second round? Help our viewers to understand what goes through your mind.
Well, markets are pretty efficient, and you generally need to compensate people who are participating in a market for taking on risk. And price or valuation in the case of these kinds of deals is the lever that people they grab for first. So often when there's a lot of risk in a deal, it will be reflected in a lower valuation. Just like when you buy a car, a used car. There's more risk if it as is with no warranty than if there is a warranty, so you're going to pay more for the car with the warranty. When risks are being allocated onto the investor, the investor tends to pay a lower price, all things being equal. And some risks can be allocated back or to the founder. So for example, if you're looking at the risk that the team might break up or one of the founders might leave, you may look at mechanisms to manage the vesting of their stock over time. Or if you're looking at a risk like the passage of time and how quickly will the company execute, you might attach an interest rate that accrues value over time to offset some of the risk of slower execution.
How about the risk from competing products? To what extent do you, before you sign on the dotted line, go out and actually purchase those products or try and download their apps or their software to try and be either a freemium or a free member or even a premium member?
You might think we'd obsess about that, and the reality is we worry less about competition than you might think. You show me an entrepreneur with no competition, I'll show you an entrepreneur with no market and no validation of their concept. So competition per se is not always bad. We look for solutions that are smart and they're differentiated from the competition and they're defensible over time, but having competition in and of itself isn't a bad thing. Understanding the market dynamics, understanding the state of the art, understanding the team's ability to compete, those matter, but obsessing about the features and functionality of a specific unit that's already on the market isn't something we necessarily do a lot of.
Do you even purchase the competition's products then?
To the extent we're doing biotech or software, those are enterprise software, those are things where you really can't buy it and look at it. I suppose if it were a consumer electronics device, it might be feasible to do that, or we might make a site visit. But remember, we're often investing at such an early stage that we'd be lucky to have a prototype to look at. And many times these are nascent markets where there aren't a lot of things on the market. But we do try to understand what's out there and whether this team's got something that's fundamentally 10x better, cheaper, and faster.
Sure. Let's now focus on the entrepreneur. What advice do you give them in terms of how much risk disclosure they should provide?
I think it's always a good idea to put it out there and control your narrative. One of the things we listen to a lot of entrepreneurs and a lot of stories, and I think that the average investor is pretty good at differentiating between competence and confidence. And so I think it's never a good idea to try to gloss over risks, because they're going to come up anyway, and it's better to get out in front of them and control your narrative. So I usually, when I'm coaching entrepreneurs, I'll tell them that it's important to sort of say, here are the what we think are sort of the key challenges, and here's how we're thinking about them, here's how we're mitigating them, here's where we're stuck, here's where we could use your help. And all of a sudden I'm mentally coming over to their side of the table going, gee, that's an interesting challenge, how could we solve that? So generally, I think that if you come into it with an attitude of partnering with your investors and solving those problems together, and a collaborative mindset, it becomes less about did you disclose the risk and more about, hey, can we overcome this together?
Back in the day, we all learned finance as base case, best case, and worst case. These days, what's de rigueur is scenario planning and sensitivity analysis. How do you come out on that debate, and how much of either do you use?
We don't do a lot of sophisticated scenario planning. We spend a lot of time thinking about what milestones are going to de-risk the company or inflect its value upward, and what it's going to reasonably cost to get to those points. And so we do a fair amount of resource planning and staging of capital. But at the stage we invest, it's very early, and it would be misleadingly reassuring to try to build hypotheticals on top of hypotheticals. So you take it as it comes to a degree, and try to understand, look at the assumptions, and to the extent things didn't work out the way they're planned, adjust accordingly, and see what you can learn about why the certain assumptions proved wrong.
Thanks, Christopher.
Thanks for having me, Greg.
Greg Stoller goes on the road to talk with Scott Allen next on The Language of Business.